Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only. It should not be considered investment advice or investment recommendation. Earning £1,000 per month in dividend income is a common goal for many investors, representing a significant milestone in personal finance or investing. While it may not enable early retirement, it certainly contributes significantly towards covering monthly bills and expenses, marking a substantial step in the right direction. Hitting this £1,000 per month from investments goal can make a big difference for people. It's like having a reliable part-time job that helps cover bills and unexpected expenses, except it's like someone else working for you. Striving for this monthly income goal encourages you to be smart with your money, making better decisions that lead to a growing income over time. This reliable monthly income not only gives you financial freedom, but also allows you to make choices based on what you want, improving your overall quality of life. Achieving this goal, however, demands hard work and discipline. The key question remains, how much do you need to have invested to reach this point? In this video, I want to go over some strategies for getting to that £1,000 a month dividend milestone, and how I'm planning to get there myself. Remember, something that works for me might not be quite ideal for you, so there could be some adjustments in your own plan. So here are some smart strategies to get to £1,000 in dividends per month, with a big focus on choosing the right kind of dividends. There are definitely ways you can go about this the wrong way, so be careful. First things first, a key part of the calculation we'll need to know is the dividend yield. I'm sure you know what this is already as a dividend investor, but in case you're new to this world of dividend investing, what is a dividend yield? The dividend yield is just a fancy way of saying how much money you get paid back out to you from your investments. Imagine you have some money invested in a company, and that company pays you a certain amount of money each year as a reward for being a shareholder. The dividend yield is like a percentage that tells you how much money you're going to get back compared to how much you have invested in buying the shares. Here's a simple formula. Dividend yield equals annual dividend over current stock price. So if you invested £100 in the company and it gives you £5 each year as dividends, the dividend yield would be 5%. A higher dividend yield can be attractive to income-seeking investors, but it's essential to consider other factors like the company's financial health, sustainability of the dividends, and potential for future growth. To keep it simple, on the dividend experiment, I'm looking for investments that pay you back in aggregate across a portfolio somewhere between 3 and 8% of what you put in. So looking at it with this key percentage in mind, we can do some simple maths to find out how much we need. So a 3% dividend yield would need £400,000. A 4% dividend yield, you need £300,000. A 5% dividend yield, you need £240,000. A 6% dividend yield, you need £200,000. And an 8% dividend yield, you only need £150,000. And this doesn't mean that you should just aim straight for the highest yield you can find and stack your portfolio with massive yielders. As a general rule of thumb, as in it's a quick guide to use, but in practice, not 100% always true, the higher the yield of the stock, the more likely it is to be cut down the line. And guess how much of a portfolio size you need on a freshly cut 0% yield. I'll let you play around with the calculator on that one. So be cautious of deceptive high yields. Excessive dividend yields, while initially appealing, can serve as warning signs for 3 reasons. Financial instability. Companies facing financial challenges may resort to distributing high dividends as a way to appease investors or maintain shareholder confidence. However, this practice could be indicative of a broader issue. The company might be struggling to generate enough profits to reinvest in its operations or address financial obligations. In the long term, relying on dividends to mask financial difficulties is unsustainable and could lead to a decline in the company's overall stability. Lack of growth prospects. Elevated dividend rates can imply the company is returning a significant portion of its profits to shareholders rather than reinvesting in its own growth initiatives. While dividends are attractive to income-seeking investors, a persistent focus on high dividends may suggest that the company lacks confidence in its own ability to expand or pursue profitable opportunities. Investors, especially those seeking capital appreciation, generally favour companies with promising growth prospects, as this contributes to the appreciation of the value of their investments over time. And the third warning sign is skepticism on sustainability. Companies offering unusually high dividends may be doing so through financial practices that are not sustainable in the long run. This could involve dipping into reserves, taking on excessive debt, or other non-viable strategies to artificially inflate dividend payouts. If such practices are unsustainable, there's a risk that the company won't be able to maintain the high dividend levels, leading to disappointment for investors who are relying on consistent returns. Sustainable dividend payments are essential for building investor trust and preserving the long-term health of a company. For me, I'm trying to target a 5.5% dividend yield on a portfolio aggregate basis. This is quite high, but not so insanely high that it's overly concerning. A 4% yield is probably the most common target yield. At a 5.5% yield, this means I need around £220,000 to hit the £1,000 a month target, or £440,000 to get a £2,000 target. So let's move on to how to build this portfolio of dividend payers. Here's what you can put in it. A dividend ETF. If you're someone who wants a kind of hands-off approach, purchasing dividend ETFs like iShares UK Dividend UCITS ETF, IUKD, which is currently popular and well known to investors, since this fund is a UK dividend ETF that tracks the performance of an index made up of the top 50 dividend yielding stocks in the UK. With a current fund size of at least £700 million, it's reassuring to investors that they're investing in an ETF that holds a significant amount of dividend yield stocks. Sector ETF. Investing in sector-specific exchange-traded funds, ETFs, offers the potential for both higher dividends and increased diversification compared to individual stocks. These funds are dedicated to specific sectors like real estate, financials, industrials, utilities, and more. By exploring various options, you can identify funds with higher dividend payouts. If you hold a bullish view on a particular sector, it may present a favourable buying opportunity. However, it's crucial to recognise that the elevated dividend yields in the sector are often accompanied by specific reasons or multiple factors. Understanding the underlying reasons for the higher dividend yields is essential to assess the associated risk. For example, iShares UK Property boasts a significant dividend yield of approximately 3.6%, reflecting additional risks inherent in the real estate sector at present. Individual dividend stocks. Investing in individual dividend stocks is the riskiest and least predictable option. Whilst you might get a higher yield and potentially experience greater growth, it comes with uncertainties. For example, if you invest in a company like Realty Income with a 5.8% dividend yield, you could earn a monthly dividend of £1,000 with an investment of just about £210,000. An alternative option when it comes to dividend investing strategy is to create a portfolio that's made up only of dividend stocks. It's similar to creating a customized exchange-traded ETF with holdings that precisely match your investing objectives and tastes. You may customize your portfolio to include companies that not only have growth potential, but also regularly increase your income by carefully choosing dividend-paying stocks. This method gives you the flexibility to customize your investment mix to better match your unique goals and risk tolerance, while also helping you achieve your financial objectives. Here are some extra considerations for hitting £1,000 in monthly dividends. Mix it up or diversify. Don't put all your eggs in one basket. Spread your investments across different types of businesses. This way, if one isn't doing so hot, the others can still make money. Go for big names, blue chip stocks. Think of these like the A-listers of the stock market. They're usually big, reliable companies that pay out dividends regularly. Stick with winners, dividend aristocrats. These are companies that have a habit of increasing money they give to investors every year for at least 25 years. They're like the overachievers of the dividend stock world. Try a bit of real estate REITs. Real estate investment trusts are a way to invest in property without actually buying a house. They often pay good dividends and can add some variation in your portfolio. How to get there quicker, the power of compounding. Consider the scenario where your invested money not only earns interest on the initial sum, but also on the accumulated interest, creating a snowball effect for your finances. While there's a formula for compound interest, understanding its essence doesn't require advanced math skills. The key lies in accelerated growth, earning interest not just on your initial investment, but also on the cumulative interest over time, akin to additional returns. As time elapses, accrued interest becomes part of your initial investment, contributing to swifter money growth in a process known as exponential growth. To illustrate, a £1,000 investment yielding a 10% annual return grows to £1,100 after the first year, becoming the new principal for the subsequent year. This process repeats, resulting in a total capital of £1,210 after 2 years. The profit doesn't solely stem from the initial 1,000, it encompasses the earnings from the previous periods too. This compounding effect can lead to substantial growth over time, particularly when diversifying investments across various avenues. Starting the saving habit early provides your money with ample time to leverage the compounding effect, optimizing growth potential. As you make regular contributions, each installment becomes part of a growing pool of invested capital. Over time, the compounding effect becomes more pronounced, leading to exponential growth. The more frequently you contribute, the more opportunities you create for your money to generate returns and contribute to the compounding process. In conclusion, achieving a consistent monthly income of £1,000 through dividends is indeed feasible with careful planning and informed investment strategies. The key lies in thorough research and understanding the dynamics of dividend-paying stocks. By focusing on reliable dividend-paying companies, diversifying your portfolio, In continually educating yourself on market trends, investors can harness the power of dividends to generate a steady stream of income and ultimately build a portfolio that pays your bills. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!